Shaping up to be Wall Street's biggest week of 2026. I mean, the data dropping over the next few days, it literally has the power to dictate the entire direction of the U.S. stock market for the rest of the summer. We are looking at a massive convergence of macroeconomic and corporate data hitting all at once. So we're going to unpack exactly what the street is looking for and, more importantly, where those hidden risks lie.
Right now, investors are bracing for an absolute avalanche of data, and it all boils down to one critical question. Is Wall Street going to continue this massive upward surge, or are we about to kick off a really painful correction? We're getting major bank earnings, fresh inflation numbers, and critical signals from the Fed, all arriving within just days of each other. It's kind of the perfect storm of financial catalysts. So, to figure out which way this pendulum is going to swing, let's break down the three major pillars driving the market this week. Pillar number one is the economy's health check. This is the official kickoff of the second quarter earnings season. And as always, the financial sector goes first.
We've got the absolute heavyweights reporting this week. We're talking JP Morgan Chase, Goldman Sachs, Bank of America, and Morgan Stanley. Literally the pillars of the American financial system. Now, analysts are going to be laser-focused on their net interest income margins and loan loss provisions. With interest rates sitting where they are, the street is looking for a bump of roughly 4% in year-over-year trading revenue from these firms. But honestly, the real focus, the thing everyone is waiting for, is their forward guidance for the second half of the year.
Because here's the thing, these companies don't just report profits. Their results give us a raw look at the true health of the American economy. They're tied into pretty much every aspect of our financial lives, so they act like a vital sign. These earnings calls are going to tell us if everyday consumers are actually feeling confident enough to borrow more and swipe those credit cards, or if default rates on things like auto loans and credit cards are starting to tick up to dangerous levels. They'll also show us if businesses are actively taking out loans to grow, or if they're pulling back and hoarding cash because they're terrified of an economic slowdown.
It's a pretty straightforward setup. If consumers are borrowing and banks are generating strong loan growth, the markets see that as a massive green light. It signals the economic engine is still humming, despite all the broader macro pressures. But on the flip side, if these giants report that consumers are tightening their belts, delinquencies are up, or business loan demand is shrinking, man, the mood on Wall Street can turn sour incredibly fast. A miss from a bellwether like JP Morgan doesn't just sting bank stocks. It can drag down the entire broader market because it flashes a huge warning sign for a potential consumer recession.
Okay, that brings us to the second pillar of this massive week, inflation and interest rates. Because even as we're tracking corporate earnings, the whole specter of inflation is stepping right back into the center ring.
The incoming Consumer Price Index, or CPI print, is arguably the single most anticipated data point of the month, and we aren't just looking at the headline number here. The core CPI, which strips out those super volatile food and energy prices, that is exactly what the Federal Reserve is obsessing over. Last month, you might remember, we saw core inflation just stubbornly hover around that 3.2% annualized mark. Well, the street consensus for this week's print is expecting a slight cool down to 3.1%. And let me tell you, if the actual number comes in even 0.1% hotter than that, it completely throws a wrench into the interest rate calculus for the rest of the year.
The dynamic here is simple, but absolutely critical. If inflation comes in higher than expected, the Fed is probably going to keep interest rates elevated for a much longer period than the market had priced in. That means borrowing money stays expensive, mortgage rates stay stubbornly high, and those capital-intensive growth stocks, they're going to face some serious margin pressure. But if inflation actually cools off and hits or even beats that 3.1% expectation, investors are going to get a whole lot more optimistic about potential rate cuts in the very near future. And that specific optimism is the exact liquidity fuel the stock market needs to keep this current rally alive.
So, let's pivot to our third pillar. We've talked banks, we've talked inflation, but we cannot ignore the true growth engine of Wall Street right now, the ongoing AI boom. Artificial intelligence is, without a doubt, the strongest structural theme driving the markets today.
We are seeing just this insatiable demand out there for advanced AI chips, scalable cloud computing infrastructure, and the training of large language models. Enterprise AI spending is expanding worldwide at a staggering pace. In fact, some research firms are projecting massive year-over-year increases in corporate AI budgets. Because of that, investors are hyper-focused on supply chain constraints and cloud revenue growth metrics from the major hyperscalers. If we see strong earnings and upbeat forward guidance from these specific tech players, especially around how much they're spending on AI infrastructure, that could deliver yet another massive boost to tech stocks across the board.
But we do have to pump the brakes for a second and shift from pure optimism to a bit of analytical caution. The biggest debate among analysts right now is simply this: are current valuations just too expensive? Like, have we priced in too much perfection for these tech companies? We're looking at forward price-to-earnings multiples in the tech sector that are stretching into historically frothy territory. So if these AI giants report great numbers, but they don't completely shatter those sky-high expectations, or if they hold back on aggressive forward guidance, the market is totally poised to punish them severely. It's a really delicate balancing act, and the margin for error for these mega-cap tech stocks is practically zero this week.
All right, let's tie all three of these pillars together in our final section, what it means for you. Because this specific combination of data creates a macroeconomic ripple effect that hits right at your wallet.
Look, whether you're an active investor, a small business owner, or just someone keeping an eye on the broader economy, this data matters. It impacts the value of your stocks and retirement accounts, the stability of bond yields, what your next mortgage rate might be, and even overall consumer confidence. Think about it. A hot CPI print pushes up bond yields and mortgage rates, which instantly makes housing less affordable. Meanwhile, a strong bank earnings report signals economic resilience, which could give a nice bump to your equity portfolio. Every single one of these financial touchpoints is squarely in the crosshairs over the next few days.
And because of all these overlapping high-stakes data drops, I do need to give you a bit of a heads up. Market volatility may increase significantly as each of these new reports is released. Professional investors and those algorithmic trading models, they are watching these numbers like a hawk. When the stakes are this high, a slight miss in bank earnings, a single 0.1% bump in inflation, or even just one cautious comment on AI spending, any of that carries the potential for massive, rapid market swings. In fact, options markets are already pricing in outsized moves for the S&P 500 this week. So, buckle up, it is probably going to be a bumpy ride.
All of this leads us to our final, overarching question. You see, Wall Street isn't just reacting to simple company profits anymore. It's trying to answer this massive macroeconomic cliffhanger. Can the U.S. economy actually continue growing while inflation remains strictly under control? Can the Fed engineer that super elusive soft landing, all while the AI boom continues to just power corporate profits? Well, we are about to get some definitive answers very, very soon. Thank you so much for joining me for this explainer. Keep your eyes